Hello, Annabel. If we could start off with you explaining what you do at M&G.
Yes, I work in M&G's fixed income department, and I'm responsible for our relationships with pension funds and their advisors.
It's been a tough quarter for bonds. Where do you think the main risks are for pension funds?
Yeah, it's been a difficult time, and the biggest risk that we see at the moment is interest rate risk. We are at a historic low. In 400 years, interest rates have never been lower than where they are today at 0.5%. A historical average has been closer to sort of 5 to 6%. So when interest rates normalise, as eventually they must, we could be looking at a pretty significant impact in terms of bond investment. So that's the biggest risk I think pension funds need to worry about with their credit portfolios. The second risk is the risk of defaults. We're living in very tough economic times with a number of household names going bust, not to mention even governments finding it difficult to pay their bills when you look at some of what's happening in continental Europe. So making sure you're invested in bonds where you're going to get your money back is a critical concern. And the third risk is volatility. With all of those risks in the market, in the financial markets, and all this uncertainty, it leads to a torrid time where markets sell off in panic and then rally in relief.
You mentioned interest rate risk being the biggest risk. How can pension funds invest in corporate bonds without that risk?
Well, they need to think about an absolute return methodology instead of a traditional market benchmark. And let me explain what I mean. When you look at corporate bonds, you can divide them into two different elements. There's a government bond element, and then there's the company-specific credit on top. And it's interesting, when you look at our analysis, it shows that the majority of the returns from corporate bonds over the last few years have actually come from this government bond element, which has benefited from falling rates. But given where we are at the moment, mathematically, it's just not possible to see a repeat of that. Rates can't fall much further. But as and when they rise, we could be looking at some significant losses. People think of government bonds as being the safest investment, but actually it's possible to lose quite a lot of money when interest rate rises. So you don't want that bit. Meanwhile, the credit spread, as it's referred to, which is the extra premium you get for investing in a company, that's actually got wider in recent years, which means that it's more attractively priced. In fact, when you look at credit spreads today versus their historic average, they're actually offering very attractive returns. So what this analysis shows is that credit is the bit you want, the government bond element is the bit you don't, and it's possible to construct a portfolio investing only in that credit bit and removing the interest rate exposure, and that's what we mean by absolute return. And to give you an example that it works, you mentioned that the second quarter has been difficult for credit. In fact, across May and June, markets fell by 6%. June was the fourth worst month for credit markets ever, and over that same period, our absolute return fund actually held its value, so it does work.
And what about defaults? Can they be avoided?
Well, it's probably not possible to avoid defaults altogether, but you can certainly limit your exposure to them and manage that risk as part of your investment. And we would say there's two ways of doing that. The first is to make sure you do really detailed analysis. We think with this sort of investment, you need to make sure that you're going line by line through the accounts, making an independent assessment to really quantify what the likelihood is of a company or a government, for that matter, being able to repay their bills. Whatever you do, do not rely just solely on the credit agency. So pension funds need to make sure their managers have the skills and the resource to do that. And the second element we would say is very important is a value discipline. That means being really attentive to the price you pay for those corporate bonds. So having made your risk assessment, you need to make sure that the return you're on offer is sufficient to compensate you for that risk. And in fact, we've done some analysis that shows that whether you're looking at individual bonds or credit markets as a whole, the entry point, the price you pay when you invest initially, has an enormous impact on the overall returns you receive. And generally speaking, if you invest when the spread is wide, you have a much better chance of achieving significant positive returns.
And the last risk you mentioned was volatility. Have you got any techniques to counter that?
Yeah, there's really two more things that we look at here. The first is breadth. Historically, credit just used to mean investment-grade corporate bonds, but increasingly that's no longer the case. Along with the development of the high-yield market, you also have secured loans, private lending, direct lending to small and mid-sized companies. So there's a a growing area of different types of credit assets, and increasingly the lines between them are blurring. So having the breadth of approach that means you can look across all of them, we find to be very helpful. And the second element is to be choosy. When you have that breadth of opportunity, you can always find some nuggets of real value. So instead of having a benchmarked approach, if you take an unconstrained approach, you're not forced to invest in something risky just because it's in the benchmark. You only invest where there are real compelling value opportunities. And this helps to dampen volatility as well. And those other points we talked about before, removing interest rate exposure and having a value discipline, are also useful in dampening volatility. So we would say, when you're looking at the risks in the current environment, an absolute return approach that looks at the multi-credit asset types and has a value discipline is a great way of addressing those risks.
Thank you very much.